What's up, guys? So a quick little informative video here, just a quick little update for people who are interested in just retiring off purely just the S&P 500 or an investment index, ideally, not a mutual fund, but investment. Just an ideal investment if you were to invest in the S&P 500 or maybe the QQQs or the NASDAQ. Just some ideas here for people on average. As you see here, this is just a cool little website to help you out, get your earnings all in play. It has like averages for everything, such as the rate of return here. It even tells you the average of the S&P 500 over the last 10 years versus the last 20 years. 1970 to 2016 averaged 10.3, whereas in the last 10 years have averaged 10 years annual return 6.6. So we could just guarantee for the next 20 years, say everything was groovy smoothie and it went up even, we'll just put it in the middle there. We'll say worst scenario, 8% of return. You're 30 right now. You have nothing invested. You want to start off with $800 a month, and the inflation's already tracked in, so this is kind of cool. Calculate it. You would retire in 29 years, which really isn't that bad considering you have nothing and you're expecting the lowest return here. And this is purely just off an index fund, like just very simple, very simple. So 29 years. Now let's say you were a bit more aggressive and you wanted to invest in something a little bit higher risk, I say. Maybe like we'll say, I don't know, Apple. Apple over the last 5 years, I believe, is up 250%. I would have to check that really quick here. Let's see here. We'll just look at the short-term Apple because it's in its mature area right now. Over the last 5 years, 150%. 150% last 5 years. So 5 years, that's 20% a year, over 20% a year, 25 exactly. And so we'll say you did something like that, where you made, 20% a year. See how significant difference that 46. So it would be 26 years there. That's best if you can invest and make 20% of your money every year in putting $800. You're pretty much a golden ticket. But it's very difficult to do 20%. So I like to use the safest number of 10%. If you just like the NASDAQ and everything was good, this is probably your best case scenario, and that you would retire in 25 years. That's pretty cool. This is just a little cool website to help people out who are just interested in that. But obviously, you don't want to miss the top 5 days of trading, as you see here. If you miss the top 5 days of trading, you've now lost 45% of that. And that's it turns 30,000 to 16,000, and this is over 20 years. 10 greatest trading days, 67%. You might as well not even be in it. And then 20 is 91%. Then you're taking a loss if you miss the 40, which is just crazy. So pretty much the best thing to do for those starting off investing is just keep it in. $800 a month will average out. If we crash and you put $800 a month every month in for the next 25 years, you'll be fine because you'll still be ahead of the game. It'll average out because then you'll be investing when it's at the bottom and when it's slowly at the top. So at the end, you'll be invested right here. And because the dividends will pay you just to hold the stock, it'll be a great way of just snowballing those effects in there. So this is just something cool I wanted to show people who are just getting new to starting investing. Just a little safe bet here. And then if you do other current sides like rent and everything, $800 isn't overly excessive. It's 20% of your income. So for those who can't afford that, you can definitely choose your own numbers here. But just something to ponder on when you guys are deciding on how you're going to invest and to look at it long term. Kind of like buying a house. You wouldn't check your house value the next day. Why are you checking your S&P 500 index fund every single day? You can. I do. But the healthy way would be doing it in a Roth IRA where it's not taxed. And then it's just set aside and you don't see that money. So just something to think about, guys. All right, just a quick video. Thanks, guys. Bye.